Welcome to the deep dive. You're tuning in because you want to get a handle on investing, right?
Yeah, maybe prepping for a chat or just trying to get up to speed quickly.
Exactly. Or, just curious about making your money work a bit harder, but without getting totally bogged down in complicated stuff.
And that's what we're here for, clear insights.
So today, we're looking at something really fundamental, I think, for anyone starting out.
Mm-hmm.
How do you actually begin investing if you only have, say, a small amount, like $100?
Right. And we found this really interesting real-world example. There's a self-made millionaire investor on YouTube who actually did this experiment. Took $100, put it into 5 different investments, and tracked it for 4 years.
4 years. That's a decent amount of time. So our mission today is basically to unpack that $100 challenge.
Yep, pull out the key lessons. What worked, what didn't, especially for a beginner.
We'll look at how steep the learning curve is for each one, the potential for passive income,
Huh.
money coming in without you doing much.
And taxes, always important. How tax efficient are these things? Plus the risk level, obviously.
And of course, the bottom line, what were the actual results after 4 years? Think of this as like a fast track to understanding the pros and cons.
And the 5 things the source invested in were pretty diverse. Individual stocks, REITs, that's real estate investment trusts, crypto, gold, and good old index funds.
Quite the mix. So should we dive in?
Let's do it.
Okay, let's kick things off with individual stocks. Buying a little piece of a company. The source of the learning curve here is pretty steep.
Hmm.
Why so involved for a newbie?
Well, it's not just picking a name you recognize, right? The source highlighted that you really need to dig into the company itself. Understand its financials, things like income statements, balance sheets.
Stuff most beginners probably haven't looked at before.
Exactly. And leadership, brand strength. It's a lot. They also stressed it's not just luck. I mean, look at their Samsung pick in the experiment.
Right, we'll get to that result. But it shows that one specific company can be hit hard by things that don't affect the whole market, like a product issue or something. That's that unsystematic risk they mentioned.
Precisely. It makes it harder to predict returns compared to, say, a broader market fund.
But the source did mention a smart way to test the waters, didn't they? These demo accounts.
Oh, yeah, definitely. These are basically simulators. You use virtual money, get a feel for how things work, practice placing trades.
Without actually risking your own $100 straight away.
It's a fantastic learning tool. Build some confidence first.
Okay, so what about passive income? Can you just buy stocks and expect money to roll in? The source rated this as good.
Well, there are 2 main ways you make money. Capital appreciation, the stock price goes up. That's the main goal for many. And then there are dividends. Some companies, not all, pay out a slice of their profits to shareholders, like a little bonus for owning the stock.
So potential for the investment to grow and maybe some extra cash along the way. Nice. What about taxes then? The source was quite positive, calling the tax efficiency great.
Yeah, but this really hinges on where you hold the stocks. They mentioned specific account types like stocks and shares ISAs in the UK or Roth IRAs in the US.
Ah, those tax-advantaged accounts.
Exactly. If you hold your investments in those, your profits, including dividends, can grow tax-free. That's a huge boost over time.
That's a big deal. But obviously tax rules are complex, right?
Absolutely. And they change. So this isn't tax advice. Definitely do your own homework or talk to a pro for your specific situation. We're just relaying what the source found.
Got it. Now, risk. Individual stocks were labeled high risk. The source even mentioned the dot-com crash.
Yeah, that story really underlines the volatility. Big potential upside, sure, but also a real chance of losing a lot, maybe even all of it if a company goes bust.
So putting your whole $100 into 1 or 2 stocks might not be the safest bet for a beginner.
Definitely not. Diversification is key, even within stocks. But that's harder with just $100 unless you use, well, we'll get to fractional shares.
All right, so the moment of truth for stocks in the experiment. The dart landed on Samsung. How did that $100 do?
Not great, unfortunately. Over the 4 years, it ended up down 32.3%. That $100 became just $67.72.
Oof.
And that includes the dividends, which were tiny, just 10 cents total.
Wow. That really shows the hit or miss thing they talked about. But they did run the numbers for other possibilities, didn't they? Like if the dart hit Apple or Microsoft.
They did, and it's a stark contrast. Apple would have turned the $100 into $170, Microsoft $188, and NVIDIA, wait for it, $198.
Crazy difference. So it really wasn't just bad luck with Samsung. It highlights the unpredictability. Strategy over luck seems crucial.
Absolutely. Research matters.
And the source mentioned the Trading 212 app specifically. It has the demo account, the ISA option for UK folks, And fractional shares. Explain those quickly.
Right. Fractional shares are really important for small investors. Say a share of Apple costs hundreds of dollars. You might only have $100.
So you can't buy a whole share.
Correct. But with fractional shares, you can buy a piece of a share, maybe $100 worth. It lets you invest in expensive companies and diversify even with a small budget. The source actually only owned a fraction of that Samsung share.
Makes sense. And there was some limited time offer mentioned too.
Yeah, free fractional share with a code, typical promotional stuff platforms do.
Okay, let's shift gears. Next up, REITs, real estate investment trusts. Sounds complex, but maybe easier than buying property. The source said moderate learning curve.
Yeah, moderate seems fair. It's definitely easier than getting a mortgage, dealing with agents, all that hassle of physical property.
No huge down payment needed.
Right. You're buying shares in a company that owns lots of properties, offices, apartments, malls, whatever, but you still need to grasp, how they work. Different types of REITs focus on different property sectors, and their income comes mostly from rent.
Gotcha. And the passive income potential was great. That sounds attractive.
It often is. REITs are legally required in many places to pay out most of their taxable income, like 90% or more, as dividends to shareholders.
Oh, wow. So that income stream can be pretty steady.
It can be, especially with long commercial leases. But it still depends on the REIT doing well. If they have lots of vacancies or the property market tanks, the dividends could suffer. So great potential, but not guaranteed.
That makes sense. And tax efficiency was also great.
Similar to stocks, yeah. In the UK, for example, you can often hold REITs in those stocks and shares ISAs, shielding the dividends and any growth from tax.
Good to know. How about risk? They put REITs at medium. So safer than single stocks, but riskier than what?
Well, they're diversified across multiple properties, which is good. Less risky than owning just one building yourself.
Right, if one tenant leaves, it's not the end of the world.
Exactly, but they're still tied to the real estate market. If property values fall across the board or a specific sector like office space struggles, the REIT will feel it. So medium risk seems about right.
Okay, so how did the $100 REIT investment fare in the experiment? It was a commercial real estate one, right?
It was, and initially the value dipped a bit, down to about $98.59, a small loss. The source chalked that up to, well, the pandemic hitting commercial real estate pretty hard.
Oh, yeah, work from home and all that.
Exactly, but the dividends kept coming. Over the 4 years, they added up to $11.93.
So that pushed it back into profit.
It did. The total value ended up at $110.52. So a 10.52% gain overall, purely thanks to those dividends buffering the initial drop. It really shows you got to look at the total return, not just price changes.
Interesting. Okay, number 3, cryptocurrency. The Wild West, some might say. Learning curve. Moderate. Really, not higher.
Well, the underlying tech, blockchain, yeah, that's complex. But the source pointed out that actually buying and selling crypto has gotten way easier.
With apps like Coinbase and Binance they mentioned?
Right. You still need to understand basics like crypto wallets, how to store it securely, and maybe a bit about tokenomics, the supply and demand for a specific coin. But the actual trading isn't rocket science for a beginner to get started.
Okay. Passive income was also moderate. I thought crypto was all about huge gains, not steady income.
Yeah, you don't get dividends like stocks or REITs. But the source mentioned other ways, like staking or yield farming.
Staking. Yield farming. Sounds like something from a video game.
Kinda. Staking is basically locking up your crypto to help run the network, and you earn rewards. Yield farming is more like lending your crypto out for interest.
Okay, but risky.
Oh, very. The rewards can be high, but the value of the coin you're staking could plummet, or the platform you're using could get hacked. Big risks. The source even said they personally preferred just holding crypto securely offline.
Fair enough. And taxes. The source was blunt. Poor tax efficiency.
Yeah, that's a downside. The rules are still evolving, but generally, swapping one crypto for another can trigger tax. Earning staking rewards is usually taxable income, too.
And you can't use those tax shelters like ISAs or Roth IRAs.
Nope. Not typically. So any gains or income are generally fully exposed to tax, which eats into returns compared to other options.
Right. And the risk level. Very high. No surprises there.
None at all. Volatility is the name of the game. Huge run-ups, equally massive crashes. It happens all the time.
The source mentioned Bitcoin and Ethereum as being sort of the blue chips.
Yeah, more established, larger market caps. Still risky, but maybe less so than tiny altcoins that can literally disappear overnight. Scams are also a huge problem, and because it's often unregulated, if you lose your crypto, it's usually gone for good. Security is paramount.
So, given all that risk, How did the $100 in Bitcoin actually do in this 4-year experiment?
Brace yourself, it turned into $652.24.
Wow, that's a 552% return.
Huge, right? But, and this is critical, the source immediately warned this is not normal. Bitcoin had an incredible run, but many, many cryptos go to zero. Past performance is definitely no guarantee. It just perfectly illustrates that very high risk, very high reward potential.
A massive outlier, really. Okay, let's calm down a bit with investment number 4. Gold. Learning curve. Low. That sounds nice and simple.
It is pretty straightforward. As the source said, you basically have two main routes: physical gold bars, coins.
Not jewelry, though, right? They warned about the markup.
Exactly. You pay way over the actual gold value for jewelry, so bars or coins. Or, the easier option for many, gold ETFs, exchange-traded funds that just track the gold price. You can buy them easily on platforms like Trading 212. They mentioned the iShares physical gold ETF.
Simple enough. Passive income potential.
Zero. Absolutely zero. Gold doesn't do anything. It doesn't produce goods. It doesn't pay rent or dividends.
So why own it?
It's a store of value. People buy it, especially when they're worried about inflation or the economy, basically to protect their wealth, not necessarily grow it fast or generate income.
Okay, tax efficiency was rated good. How does that work, especially for physical gold?
Yeah, physical gold taxes can be tricky. Depends where you are. Might be capital gains tax when you sell, but some legal tender coins, like UK gold sovereigns the source mentioned, can be exempt. Gets complicated.
But the ETFs are simpler.
Much simpler, usually. You can often hold gold ETFs in tax-advantaged accounts like ISAs, just like stocks or REITs, making gains tax-free. That's a big plus.
And the source mentioned something about carrying physical gold across borders.
They did touch on that unique aspect. It was a way to move wealth discreetly, but obviously that comes with its own risks like theft or confiscation, not really a standard investment strategy.
Fair point. Risk level for gold. Medium. Why
Yeah.
medium if it's a safe haven?
Because while it might protect your capital during downturns, it often lags behind other investments when times are good. There's an opportunity cost. You might preserve wealth, but you might miss out on bigger growth elsewhere. So less volatile than stocks perhaps, but lower growth potential too. Medium seems right.
And the $100 gold ETF investment in the experiment, how did it do?
It did pretty well, actually, a solid 40.1% return. The $100 grew to $140.10.
Decent. Not Bitcoin numbers, but steady.
Exactly. It reinforces that idea of gold being about steady growth and wealth protection, not hitting home runs.
Okay, last one. Investment number 5. Index funds. Learning curve. Low. Probably the easiest.
Very likely, yes. Index funds are the classic passive investment. You're not picking stocks at all.
You buy the whole market, essentially, like the S&P 500.
Pretty much. You buy a fund that automatically holds all the stocks in a specific index, like the S&P 500 in the US or the FTSE 100 in the UK. Diversification is built in. Getting started on platforms like Trading 212 is super simple, just a few clicks.
Minimal effort required. What about passive income? They rated it moderate.
Right. The main aim is long-term growth as the overall market grows. But the companies within the index fund, many of them pay dividends.
So the fund collects those dividends.
Exactly. And then it usually passes them on to you, or automatically reinvests them to buy more of the fund, helping it grow faster. So yes, there's an income component, though maybe not as high as a dedicated dividend stock or REIT.
And tax efficiency was great again?
Yep, same story as stocks and REITs. Hold your index funds in a tax-advantaged wrapper, like an ISA or Roth IRA, and all the dividends and capital gains are tax-free. It's a very efficient way to grow wealth long-term.
Makes sense. Risk level.
Yeah.
Low. That's the big appeal for many, isn't it?
Absolutely. Because you're spread across hundreds, sometimes thousands of companies, the failure of one single company has very little impact.
You're not exposed, like with that Samsung stock.
Precisely. History shows that broad market indexes like the S&P 500 have delivered average returns of around, say, 8–10% per year over the very long term. Of course, there are down years, market fluctuations happen.
But holding steady for the long run is the key.
That's the generally accepted wisdom, yes. For most people starting out, it's considered a very sensible, low-risk approach.
So, the final result. How did the $100 invested in an S&P 500 index fund perform over the 4 years?
It did very well. A 79.5% return, turning the $100 into $179.50.
That's really solid.
Yeah.
Better than everything except that crazy Bitcoin result.
Exactly. And the source really highlighted this as a compelling option for most investors. Simple, Low cost, diversified, and historically strong returns. They even mentioned index funds are the core of their own portfolio, just adding other things around it.
Wow. Okay, so this $100 experiment, it really laid out the landscape, didn't it? Each option has its own flavor.
Totally. Different learning curves, different income potential, different tax implications, and crucially, different levels of risk. Some are clearly aiming for rapid growth, others more about keeping your money safe.
And I think maybe the biggest single lesson, the one the source kept coming back to.
Is just start early. Even if it's only $100 or $50 or whatever you can manage, getting that money working for you over time. Exactly. That compounding effect is incredibly powerful, letting your returns generate their own returns. That's how wealth is built over the long haul. Starting small is way better than not starting at all.
Definitely. So for everyone listening, maybe the question to mull over now is, which of these paths, or maybe a combination of paths, feels right for you? Considering, how much you know now, how much risk you're truly comfortable taking on, and what you actually want your money to do for you in the long run.
Yeah, it's about finding that fit. It really gives you food for thought on what your own first or next step in investing might look like.